Investment banking is one of the most profitable fields in the financial industry. If the sound of money gives you a tingling sensation, then definitely this is the field worth exploring. And today, with this video, we are going to unscrew the nuts and bolts of the term investment banking. So what is investment banking? Investment banking is a branch of banking that organizes large and complicated financial transactions such as mergers or IPO underwriting. Basically, the investment banking institutions raise money for their clients. Now to contemplate this clearly, let's look at an example. During the period of the Civil War, the US federal government needed more money to finance their military initiatives. However, they had no bright idea how to raise this substantially large amount of money. And about that time, investment banks stepped up and laid the foundation for what we call securities or bonds today. These securities act as a guarantee that the entity taking money will return it back with a decided interest schema. So, investment banks took these securities from the US Federation and sold them to the investors looking to invest. And by doing so, they earned the profit for being the middleman from both sides. So, if I have to intuitively put this forward, that investment banking can be considered as the bridge between demand and offer. They are bridging the people who have capital and are eager to invest and the people who need financing for one of their projects. Now let us talk a little bit about a career in investment banking. Guys, remember that the world will always require companies that can drive innovation. These creative companies will always require large investments. Also, people who have money will constantly hunt for possibilities to invest for savoring their future. And hence, the world will always require these investment banking institutions and professionals to drive this money. The average salary for investment banking professionals in the US lies around a whopping amount of 113,000 USD, whereas in India, the salary averages around 12 lakh rupees. However, it can go up to a gigantic amount of 70 lakh rupees. That's all we have for today. Thank you for watching the video and make sure to hit the subscribe button and bell icon to come across more such videos.
Let's start this session by understanding what do investment banks do.
Let's begin with a simple example of a company named ABC. Suppose ABC wants to merge with another company. How will it know that the other company will be beneficial for it? Or how is it going to raise the desired funds? And who is going to handle the complete documentation and help in figuring out new investment plans? Well, the short answer to all these questions is an investment bank. Investment banks play a vital role in making a company go big by acting as a risk taker or say middleman. Typically, investment banking focuses on two main areas. The first one is the M&A advisory and next we have underwriting. So M&A advisory stands for Mergers and Acquisitions Advisory. It is the process of assisting corporations and institutions in locating, evaluating and completing company acquisitions. Underwriting is a procedure used by banks to get funds from investors for a client, mostly in the form of equity or debt securities. Now let us move on to the next topic, which is how do investment banks work? Investment banks are divided into two types, the sell side and the buy side. Now the sell side shares of newly issued IPOs, provides market making services, places new bond issues, and assist customers with transactions. Coming to the buy side on the other hand trades securities such as shares and bonds in order to maximize profits. It collaborates with hedge funds, mutual funds and pension funds. Now let us take a look at the careers available in investment banking. Investment banking jobs are among the most desirable jobs in the financial industry. As an investment banker, you will be expected to assist the clients in raising funds and expanding their businesses. Though it is not that easy to get into the domain, once you make it through the journey, the results are really rewarding. The average salary ranges around $100,000. With years of experience, you can even earn up to $500,000 per annum. The main role that investment banking demands is to provide assistance to firms, governments, and wealthy individuals in expanding their businesses by acting as a medium that will handle the complete procedure of analyzing and evaluating the business and will also manage all the documentation work involved in the process. The world of investment banking is not for everyone to live in. This job profile comes with a very high competition and extremely tight working hours. But the financial perks offered are unparalleled. You will live a very fast paced life and deal with exquisite clients while enjoying a lifestyle that others can only dream of.
Moving on, we will see how does investment banking work.
Well, by now we made it clear that investment banks act as a bridge between the investors and the project owners who require money. Well, the other way to put this around is investment banks are the bridge between demand and offer. They are bridging the people who have capital and are eager to invest and the people who need financing for their own projects. In the initial days, government entities were the main clients of these investment banks. Governments took support from these banking institutions to build highways, railroads, to improve infrastructure, to fund military operation and whatnot. Now, what these governments used to do is they used to issue some bonds and approach investment bankers or middlemen to produce some sort of financial solution. The reason behind approaching these so called middlemen was pretty simple. The government did not know how to price their bonds, how to sell them in the market. They were not at all unbiased in the negotiation of proper terms, and individual investors did not think that their investments will be protected without having the higher bargaining power. These facts tell you how important our middleman or investment banker was. Now, from this point on, the investment bankers used to take on the business. Their main task was to negotiate great deals with government to sell a fraction of their bonds to their investors. And before even doing that, they used to visit the investors and create a list of those who were ready to purchase the bonds the government had. Just to be clear, that they could resell all the bonds issued and would not be stuck with any of those. Now, all this sounds quite easy, but wait, there is more to this. Actually, there are two types of scenarios both the investors and investment bankers can face. The government can default and stop repaying its debt, or it could try to renegotiate the terms. I mean, both of these scenarios are not good for investors, hence, use the middleman. Now, let me give you an example where this scenario happened for real. In 1842, eight American states defaulted because their economies relied heavily on the production of cotton, and the price that year was too low. These states could not repay their loans and refused to pay it. Now, this puts the capital of investors at substantial risk. The middleman who arranged this sale reacted in a decisive manner. All the attempts of these states to raise a new capital were unsuccessful. James Rothschild was the name of this famous middleman. This famous investment banker was quoted saying to a federal state representative that you may tell your government that you have seen the man who is at the head of financier of Europe and that he has told you that they cannot borrow a dollar, not a single dollar. As a result of these Rothschild's actions, the defaulted states agreed to a restructuring plan, which satisfied the investors and repaid them their capital. This scenario proves how important it is to have a reputed investment banker in deals like this. Now, this is a scenario of past. What about now? Well, the thing is, investment banks still do work the same. It's just they offer a variety of services now. They definitely still do raise capital, but besides that, they have specialized in areas like mergers and acquisitions, underwriting, private equity, and venture capital. These banks hire quite a number of employees every year in roles such as banking analyst, investment banking associates, portfolio managers, private wealth managers, market research analysts, investment strategists, investment consultants, and many more. And using these sets of people, they run the empire of money. Different teams work on different sets of deals in the particular demographic areas. And the presence of these top investment banks is of global level. They have rooting in almost every industry and every country possible. Also, these financial institutions have been around for centuries now. Hence, people do put immense amount of trust in their names. Now, just to give you an idea, here is the list of notorious investment banks across the globe. We have Barclays, JP Morgan, Citi, Credit Suisse, Goldman Sachs, Deutsche Bank, Merrill Lynch, and Morgan Stanley. Now, the youngest of these banks is 88 years old. And if we talk about their average age, it is significantly higher, that is 187 years. I hope these statistics help you contemplate the huge market experience these financial institutions bring to the table and how big of a deal they are. Now, moving forward, let's look into the career prospects that you can look out for in the field of investment banking. It is crucial that you understand the world will always need companies that could drive innovation. Those innovative companies will always require huge investments, and also the people with money will always look out for opportunities to invest and savor their future, which clearly depicts the need for our middleman, that is, investment banking in this world. And hence, you should believe that investment banking is here to stay and it will. More increasingly, if you are looking to build a career around this field, then as a beginner, you could be entitled to the salary of 113,000 US dollars in the United States of America, whereas in India, you can expect the average salary of 12 lakh rupees, which could also go up to 70 lakh Indian rupees. And the best way to climb the ladder of success and gather lucrative offers is to learn the intricacies of investment banking operations.
Up next, we have what is a financial system?
As I told you earlier, once again, I'm telling you, it might appear basic to you, but again, a very good understanding will set the foundation for the future module. So you'll have multiple module. Today, we are starting with very basic, and gradually we will graduate to a more tougher area, but this is going to set your definite foundation. So let us see, when we talk about the financial system, what are the different things in the financial system, or what are the different elements of a financial system. So first of all, in any financial system, first of all, there are participants, then there are markets, products, and services. So you'll say participant means what? So participant means it could be bank, it could be mutual fund, it could be insurance company. All these particular participants ultimately work in a place called market. So right now, let us talk in a very simple manner that if I talk about a capital market, where they do work? They work on a stock exchange. So stock exchange become market for us. So if I have to do any particular transaction, it is essential that I will have to have a trading account, which is ultimately linked to either Bombay Stock Exchange or National Stock Exchange, and that becomes the market. Product. So product could be anything. Suppose if I'm dealing with an insurance company, it would be an insurance product. If I'm dealing with a stockbroker, it would be the broking services. If I'm dealing with a bank, it would be banking services. So products and services would be there. Just in very simple word. So nothing great in this particular slide. Now let us move further, and you can see in the top and at the bottom, there are two words which is mentioned in the slide: indirect finance and direct finance. Before I actually go as per this slide, let me just give you an overview that in the entire financial system, what is the basic idea about the capital. So suppose if we talk about any particular private company which becomes a public company, which means now it is a corporate which is listed, let us say Tata Motor or Reliance Industry, these are the listed company. So essentially I am just giving you a very raw idea so that ultimately you start visualizing the situation. The moment you start thinking like a story, like a visualizing situation, you will be in a more better position to understand all the ins and outs of that. That will help you later on dramatically. So when I say that any particular company requires capital, the first question is, why does a company require capital? The company already is very big in size. Why does it require capital? So as an individual or as a company or as a country, if anyone has to go beyond a particular point, if they have to grow beyond a particular point, then the own capital is not always sufficient. They have to get some extra capital if they have to expand their business in any particular manner. So if I have made up my mind that as a company, as a promoter of my company, I want to expand further, I have two prominent ways of raising the capital. One is called equity capital and another is called debt capital. Now, what is this equity? Equity is nothing but own capital, which is my own capital. And when I say debt capital is not nothing but borrowed capital. Still, if it is not making sense to some people, sir, what is this own capital, borrowed capital? Let us go further in a very simple manner. I have today a company. Just listen as a story. I have one company, it is Tata Motor. 100% ownership of Tata Motors is with me. I am say like Ratan Tata, and I have 100% ownership with me. Now I thought I want to raise say like 1,000 crore or say like 5,000 crore or 10,000 crore of money from public. So there are two methods. Either I go to a bank and borrow the money. Another method is I don't want to borrow the money. I want to go into stock market, into the area of stock market, and get money raised through the public. So what I will do, I will say that I will dilute stake in my company. I will sell certain shares in my company. Let us say 10% of my holding, I will dilute it in favor of the public. So it means now from future months onward, I will have only 90% ownership in my company, and the 10% ownership is ultimately diluted in favor of different public. So there are public across India. They will ultimately subscribe shares of my company in the process of IPO, which is called initial public offering. After that particular IPO is over, these particular shares will get listed on the stock exchange, and then they can decide whether they want to own the share or they want to sell the share. So once they bought the shares of my company, now I am not 100% owner in my company. I am 90% owner in my company. So who is 10% owner? The public. So it means the money that I've got from the public, this is called equity capital, which is nothing but the own capital, which was earlier my own capital. Now this own capital belongs to some outsider. Now, what is the point of raising money through equity? When you raise money through equity, there is not a compulsory requirement that you have to return back this capital to the public. Let us say that we raised 10,000 crore from the public. Is there any compulsion that we have to repay this money to the public? The answer is no. You can hold this money for any number of years till the company is in existence. Your money is with you. So ideally, we can say it's a very, very, very long-term capital. Whenever we talk about capital, we have to identify whether the capital is long-term in nature or short-term in nature. Imagine if you have a short-term capital, there is always pressure to repay that capital. But if it is long-term, you don't have to worry. You know that in the long term, we will grow very well. We will make a lot of profits. Our company will double in size, triple in size. So no, nothing to worry about. So basically, this is a long-term capital. Now the question is, you have raised money from the public. Is there any obligation to pay something to the public? Whenever the company raise money through share, and company makes profit, the company has the option to pay to the shareholder dividend, which is nothing but distribution of profit. I'm repeating once again in simple word, the company has the option to pay dividend, but not a compulsion to pay the dividend out of the profits of the company. It means that so far you are clear that this method of raising capital is very long term in nature. You do not have to return back the capital. Only the owner of the company has sacrificed certain stake in the company. Let us say 10%, 56 stake is gone, but he got the capital permanently, and there is no obligation even for any particular payment of dividend also. He may pay, he may not pay, whatever is the situation. And of course, if the company does not make profit, for example, currently you can see Paytm, Zomato, these are listed companies and they are not making profit. So they are not under obligation to pay dividend, because if then there is no profit, how they pay dividend? Now let us go to the other part. That is basically the company has started raising money by borrowing from the bank. So if you borrow from the bank, first of all, there is a definition that ultimately after a certain tenure, a certain duration, you are under a compulsion to repay that money back to the bank. There is always a compulsion. Suppose if I bought a 10-year loan, so after 10 years, I'm supposed to return that money. If it is a 5-year loan, I have to return after 5 years. So there is a compulsion with regards to repayment of capital. The second is, against this borrowed money, there is a specific interest tag. Let us say that I borrowed money from bank at the rate of 10%. So whether I make profit or I make a loss, I am under compulsion to make the payment in the form of interest to the bank. Imagine if you are already making a loss and still further you make payment of interest to the bank, that interest will ultimately compound your loss further. If suppose if my loss was 900 crore and I'm making 100 crore of interest payment, my loss will get accentuated. It will enhance by another 100 crore and it will become 1000 crore. To certain extent, ultimately the debt becomes a problem. Now the question is, if debt is a problem, then why to raise money through debt? Always keep raising money through equity only. Beyond a particular point, no particular promoter will like that he should keep diluting the stake in the company. Today I raised money by giving 10% stake. Again, might be after 2 years, I will again sell my 10% stake, but there will be a certain limit beyond which I do not want to sell the stake. And if you're not able to sell the stake in your company, then how come you are going to raise the money? So that is a very important point, that you have to strike a balance. Later on, when we further advance and we study any particular thing related to finance, that time I will explain you that ideally what should be the debt to equity ratio for the purpose of raising the capital. There are certain ideal standard that has to be followed for the purpose of striking a balance between the capital raised through equity and through the debt. Now let us come to this slide. That was just a background explanation, but now let us come to the slide. So first of all, on the left side, means in the yellow box, you can see that there are certain people who are basically providers of finance. These people are providing finance. So one is called lender. So lender obviously would be like financial institution. It could be bank. It could also be an insurance company which can lend money. Now, suppose somebody say, so insurance company, how it lends money? Understand the business of insurance. Insurance company collects crores of premium from the people, but the claims does not comes all of a sudden. The claims would be say like 1%, 2%, 5% as per the claim history. It means whatever premium they have received, ultimately they have to grow that particular premium. They have to generate some profit out of that premium. In other words, we can say that crores of money which is received at premium, these insurance company will be investing. So investing means what? Let us say they say that they want to lend the money. So to whom they will lend it? They will not lend to public. Usually the insurance company will lend the money to the government of India. So government of India is also borrower. If you come on the green side, on the right hand side, you will find under the borrower, just the second last entity is government. So government in India, I personally feel, is the biggest borrowing entity, because to run a country you need the maximum amount of borrowing. So government of India maximum borrows, and the maximum lending that is done, I feel that it is like insurance company, that too particularly LIC, sometimes even more than the individual bank that the LIC would be lending. Apart from the lenders, you can see there are savers who are giving money. So you will say, how savers give money? Savers deposit the money in the bank, and ultimately these deposits by the bank is given to the people in the form of loan. So that is the reason that even government encourages people to save money, because if you will save money, then only you will deposit money. If you will deposit money, then only banks will be able to give loans to other public. Imagine a situation, a country that a person does not want to save. They say, I will live today. I do not want to live for the future. Live in the present. And I'm not going to save any single penny. How the bank will get the money? And if the bank is not getting money, how do we lend the money? If they are not able to lend the money, how the corporate world will grow? So this is a complete cycle. That is the reason that in under Income Tax Act, different area, we keep on getting certain tax benefit, that if you save this money, you will get this tax benefit and so on. So these are the certain lender. These are the ultimately borrower. In between, you can see there is a financial market. So whenever the money goes, it does not go from lender to borrow directly. It is channelized through the financial market. So we say financial markets, what? Banking, you understand very easily. Let us say I was talking currently about a company, say like Tata Motor. So all those people who have saved money, let us say if Tata Motors come with an IPO. So what does the Tata Motors will do? It will take money from these particular people by issuing a certain share, which is called IPO. And once these particular shares get listed on the stock exchange, ultimately it will be given to those particular people who are investors. They will be the investor who will start holding the shares, buying the share, or trading the share, whatever be the case. This year, it is anticipated Tata company is coming up with one big IPO. I think it's Tata Technology, not Tata Consultancy, Tata Technology. That is expected that this year it is going to hit the market, which is going to be one of the biggest IPO. So this is about the direct and indirect finance. IPO is nothing but initial public offering. If you go by the name, initial public offering. Again, read that particular word, initial. What is initial? First time. Public offering means what? I'm offering to the public. What are you offering to the public? The shares in my company. So I'm asking the public, these are the shares in my company. I'm coming for the first time to the stock market. Would you like to buy the shares? If the public shows interest, then they will subscribe to the shares of the company. As you have seen in the year gone by, Zomato, Paytm, many companies, Nykaa, many companies have come to the market and they have listed the stock exchange. So this is nothing what we call IPO. If already a company is listed in the market and still further they want to raise capital, then we don't call IPO because it's already listed. IPO means what? Initial public offering. Now it's no more initial. Then we use the word called FPO, which means follow on public offer. So already the public offer was done earlier. Now this is a follow on to that. So we will say it is a FPO. So in mostly IPOs come in the market. FPO are quite rare in the market. It's not that it does not come. It's quite rare, but mostly we will see in the market, which is called IPO. Yeah, the direct finance simply means that if you go to the bank and you directly take money from the bank, or you can say that through certain particular financial intermediary, you are basically taking. What is intermediary? Let us say it is a bank. So one person gives money to the bank, that is the depositor, and you go to the bank and you take money from the bank. So basically, it is just through the bank that these two people are connected, borrower and lender. This is called indirect finance. When we talk about the direct finance, which is rooted through the financial market, that is basically called as a direct finance. So, for example, IPO. What is happening in the IPO? Ultimately, people who have saved money, they ultimately give it directly to the company. What happens in the IPO? You do not give to someone else. You fill up the application form, the money goes directly to the company. So that is the reason we say it's a direct finance. You're not saying that I'm going to give it to X person, then the X person will give it to Tata Motor. If it is Tata Motors IPO, you are directly giving the money to Tata Motors through the IPO route. That is why we say it's a direct finance. So now we move to the next part. Basically, what are the functions of a financial system? So you can read it. I'm not again going line by line, but basically, if you see in the bottom, we have tried to ultimately correlate different entities with each other. So suppose if it is stock market, bond market, short-term fixed security market. What is short-term fixed security market? Any particular instrument like bond, which is issued for a very short period of time. So it might be for 6 months, 1 year. There are different short-term maturities market, which we will discuss. What are those instruments? So those instruments also form part of the financial system, and ultimately there could be banking sector, that could be government, and ultimately all this particular money, whether it is from stock market or from the banking or from the bond market or from the government, ultimately it goes to whom? To the firm. We say firm, so what do we mean by the firm? Firm is nothing but industry is nothing but, in layman term, we can say a company. So a company can raise money through any of these modes. Definitely any particular company will raise. Let us talk this sub, because right now Adani is very prominent company because of its news. So Adani has hit the market for shares also. There are shares which are listed, so they got money through shares also. They have certain bonds which are listed in overseas market, so they got money through bonds also. They have borrowed money from the Indian banks and multinational foreign banks also, so it means they have got the money from that source also. So this is a very ideal example where they have tapped money from different sources, and all these sources collectively, when they give money to that, we say all these are part of the financial system. Normally people get confused that when we are talking about a financial system, or when we talk about capital market, it is just stock exchange. Not necessary. Later on you will see that capital market includes even commodity market, foreign currency market, interest rate market, banking sector, any particular thing which is connected with the capital raising activity or capital lending activity or capital formation activity. All this collectively is called basically a financial system. So that was just basically given here. We will talk more about the financial system. So now we see about the structure. We talk about the structure. The first term that we encounter is financial instrument. What is financial instrument? Very simple word: shares, bonds, debenture. That is instrument. That is the any particular instrument through which you raise money. That is called financial instrument. Financial regulator. Of course, I will talk later on also, but just to give you a fair idea, financial regulator is nothing but a particular body for every specific sector, which ultimately governs certain laws, which lays down the terms and condition, which tells that if somebody is in violation of those terms and condition, then what would be the panel provisions applicable for them, which could be very harsh as good as say like imprisonment also, or fines or penalties, or somebody could be completely like thrown away from the markets also. They could be delisted also. Anything could happen. That is the role of the financial regulator. So in simple words, we can say that ultimately the investor protection is the primary objective of the financial regulator. The second thing, whatever companies are doing, that should be completely transparent. For example, if the companies are preparing their accounts, so whether the account statements are transparent or not, whether they are properly audited or not, all this is also one of the duties of the financial regulator. So I will touch upon this part later on also, but I hope the point is clear. When any particular sector is having a regulator, the investor is confident that ultimately money would remain safe, for one simple reason: because everyone is working as per the regulatory norm. So right now, many people will ask, can we trade or speculate or invest in cryptocurrency? So the very basic answer is yes, if you want to do, no one can stop you, but ultimately there is a great amount of risk because it is not regulated. So if it would have been regulated, then I would say, yeah, the risk is always there, but yes, to a large extent, there is no counterparty risk or no default risk because it's regulated. But currently, that particular segment is not regulated. So if anybody is doing any transaction, it is at his own peril, it is at his own risk. So that is the basic about the point is not about discussing about the cryptocurrency. The point is discussing about the financial regulator. The third is financial market. So now, by and large, you've understood when we particularly talk about a place through where you are raising money, where things are getting traded, that is called the financial market. So it could be a stock exchange, it could be just a common place, it could be a banking place, that is called a financial market. Financial participant, all those people who collectively participate in this financial market are called financial participant. For example, in simple word, investor, borrower, lender, raiser, issuer, banks, mutual funds, all these are nothing but the financial participant. And financial services, as we discussed, and more we will discuss later on. This is just given as a gist on this particular slide. More detail we will discuss it. The financial services, it could be like broking services, depository services, merchant banking services, underwriting services, and also one of the important thing that we will discuss later on, it is investment banking services. So right now we are talking all basic thing because it's part of the financial market. Later on we will study investment banking. That also becomes one of the prominent things about the financial services. You can see here in detail we are going to talk one by one. So first of all, first thing first, financial participant. Who are the financial participant? It is given investment bank. Currently, I'm not talking what is investment bank. At a proper time, I will discuss in detail with example what is an investment bank. Up in financial market, you have retail and corporate banks. Then you have mutual funds and hedge fund. Just briefly, what is hedge fund? Hedge funds are unregulated entity, and basically they give services to HNI. What is HNI? High net worth individual. Usually the hedge funds come from advanced countries like USA and UK, and the mandate of hedge fund is that whoever HNIs have given money to them, they are expecting super normal return. They don't mind even if you put the money at.
If you want to make a career in data science, then Intellipaat has IIT Madras Advanced Data Science and AI Certification Program. This course is of very high quality and cost effective, as it is taught by IIT professors and industry experts.
Big risk. So for example, those people may come, they may short in the market, they may take exposure in a commodity cycle, they may take exposure in some alternative investment. They can do anything. There is nothing regulated. But the objective of hedge fund is ultimately they had to generate super normal return. In the event of doing that, there can be a possibility that even they can lose significantly the investors' money. So investors are ready for that particular situation. They say, but we want returns which is super normal in nature. That is the role of the hedge fund. In India, we do not find India-owned hedge fund. But in India, the hedge funds that are operating, that usually comes from the overseas country. Next, we have the government. So you will say government is also financial participant very much. Government companies are listed. You know that a lot of public sector undertakings are listed. Government borrows money. We have government banks also. We have government insurance company also. So government is also in a big manner a financial participant in the system. Stock exchanges, I don't have to tell, but yes, I just want to say prominently in India, we have two exchanges, Bombay Stock Exchange and National Stock Exchange. But apart from that, we have a lot of regional stock exchanges also. So for example, in the class I've seen one person, I think is from Kolkata. So we have a Kolkata Stock Exchange. I think there are other stock exchanges south also. But the activity on those stock exchanges is very, very minimal. Almost no activity. So even within BSE and NSE, if you go by the volume, what is the traded volume of each day? National Stock Exchange has the highest trading volume every day. I think it would be 3 to 4 times more as compared to the Bombay Stock Exchange. On the contrary, the Bombay Stock Exchange is the oldest exchange in India. I think it started operations in 1979, and somewhere in 93 or 94, National Stock Exchange started. But National Stock Exchange was more technologically oriented. It was the first stock exchange which started on online screen-based trading activity, and now it has got the maximum number of trading volume on a day-to-day basis. Coming to the depository part, so depository, more detail we will discuss. We have one slide dedicated to that. But depository simply means that whenever a particular person is holding shares in electronic form, in digital form, which technically we say dematerialized form. That is nothing but a depository is required. So you need to open a depository account where your dematerialized shares are stored. Just to give a idea that why are we talking about demat. So in older days, like prior to 2000, most of the Indian shares were in physical form. So what do we mean by physical form? So let us say that if today you want to see the insurance policy, you still can see the insurance policy in physical form. But tomorrow when insurance policy also become dematerialized, the word is coming dematerialized. What is dematerialized? The anything where you put D, it means that thing gets over, means the material is getting over, and you are converting that particular physical activity or physical form into digital form or into electronic form. That process is called dematerialization. So now in today's scenario, almost I don't have the exact statistical record before me, but I can say that almost 99% or even more than that shares in the stock market are completely dematerialized. They are held in demat form only. So when you hold shares in demat form, transfer of shares from one person to another person becomes instantly. It does not take time. It happens on a real time basis because now we are doing the transactions based upon the internet. But go before 2000, when shares used to get transferred on a physical basis, so it used to take 2 to 3 months to get transferred from one person to another person's name. I've seen that era also when my grandfather or my other relatives used to hold shares in physical form. So 2 to 3 months is used to take. It means enormous time used to be taken for transferring shares from one place to another. So because of all this electronic mechanism, now demat has become one of the very important activity. And within 2 3 years maximum, all insurance policies will also be held in the demat form only. Currently also you can hold insurance policy or mutual fund units as an option. It's not compulsory. Even mutual funds you can hold in demat form. But in future, everything will be completely in digital form only. Let us move further now. When we talk about other things like other participants, so you can see retail investor. I don't have to speak much about it. You know that insurance and pension companies. So there are a lot of insurance and pension companies. Mostly pension companies are related to insurance only, but there is a separate another thing which is called NPS, new pension scheme, for which we have a separate altogether place only where we can start creating pension for our olden days also. Registrar is nothing but if you have heard the name of Karvi, some people are from Hyderabad side also, so definitely you know Karvi because it started operation from Hyderabad. So Karvi is a registrar. Registrar work is just to hold all back office activity on behalf of the company. For example, let us say it's the Reliance Industry. So who are the total shareholders of the Reliance Industry? Each shareholder is holding how many share? Ultimately, if the company says dividend, then posting the dividend or sending the dividend to the individual's bank record, sending the annual report of the company to each individual shareholder. If there is any particular meeting of the company, then sending the intimation or notice of that meeting to individual shareholder. All this back office activity on behalf of the company is done by the registrar. So sometimes we say registrar, I would add one more word also to that. Sometimes we call registrar and transfer agent. It is nothing but RNT agent, registrar and transfer agent. One example I'd given Carvi. Another prominent example is called CAMS. This is a listed company in the market. It is called CAMS. Apart from that, there are many other small and big companies, but these are the two prominent companies which does the work of the registrar. Then you have the clearing houses. So clearing house simply means that, of course, we will in detail, I think in the second, third, fourth module somewhere, you will see the detailed procedure of clearing and settlement. But right now, clearing simply means that whenever basically you sell the share and somebody else buy the share, ultimately through the stock exchange, all this goes to the clearing house. And on the clearing house, this transaction will get cleared and then only the person will receive the share. So it is not that if I sell the share directly from my account, it goes to the buyer's account. It will go through the process of clearing mechanism and then only the other person will receive the share. It is just like, suppose if you give a check to someone. So what happens? The other person deposit the check in his bank account. But from that particular bank, it goes to the clearing house. At the clearing house, it will be identified whether the check is genuine, the date is put proper, the signature is matching or not, whether the concerned person's bank account has a relevant or a sufficient balance in his account or not. And once everything is okay, then they will say, yeah, this particular check should go through and the other person account will be credited. The same thing happens in the stock market or in any financial market, that whatever transaction has taken place, it has to be verified. that is to be done in a clearing house. And once it is passed from the clearing house, then ultimately the other side of the transaction takes place in the buyer or the seller's account. Broker, intermediary, simply intermediary, that is, we can say middleman. Like whenever you do a transaction, you have to do through a broker. You cannot say I'll directly sell to another person. You have to get registered in India with a particular broker. I hope you almost everyone must have heard different names like India Infoline or Sher Khan or Motilal Oswal or Geojit Financial. So these particular broking firms act as intermediary. They provide you the trading platform. You have to get registered with them through proper KYC norm, and then you can start trading and investing through these broker. Custodian, mostly in India, you will not find the concept of custodian in the context of investor, but the role of the custodian is simply to safeguard or safekeep the assets on behalf of the customer. So let us say if I am talking in the context of mutual fund. So what does the mutual fund do? The fund manager holds the cash basically in the bank. Let us say that I have invested in X mutual fund, say like 1 lakh rupee. So 1 lakh rupees goes to mutual fund, but mutual fund owner or the mutual fund manager does not keep cash with himself. He park that money in the bank. Now out of that money, he buys certain securities in the market. So when he buys certain securities in the market, those securities are also not kept with the mutual fund. Just like you keep the money in the bank, similarly you keep the securities with the custodian. The idea is that the ownership and management should remain separate. Otherwise, there can be a chance that people can trade in those securities because they are having access to that security. So they can trade it for their own individual benefit also. So that is the reason they keep it separately. Another example would be suppose if some foreign investor or foreign institution investor, typically we call it as FII. FII has to come to India and invest. So that FII will not come into India. They will just register. They will be in USA, but they will set up a desk and they will appoint a custodian and they will give all the payment authorization and whatever they have to hold the shares on behalf of them, that right to the custodian, and custodian will act as an intermediary for holding the shares and bank balances on behalf of the FII. So I hope the custodian word itself tells you it is coming from the word custody. And I hope everybody understand what is the meaning of the custody. That is to keep something in our custody. That is called the custodian. So this is something about, just move and see one more thing now. When we talk about financial market, you see there that below capital market, money market, FX market, and derivatives market. Everything we will discuss in detail. But when we talk about capital market, mostly we are talking about, say, like you can see below the capital market, primary market and secondary market. What is primary market? Whenever the company hits the market for the first time, that is whenever they launch any particular share or bonds, that is called basically the primary market. If you want to make the primary market more successful, then the company should think about going into secondary market also. That means it should get its shares and bonds and debenture listed in the stock exchange. If you get that thing done, it means then your primary market is also very active. In simple word, if I know that if I am buying a particular company shares or bond and eventually it will be listed, so I know that I can ultimately sell the shares on the exchange. But let us say if somebody raised the money through bond or through share and it is not listed, then I would think, what is the point? How would I get the price discovery? How will I find a particular buyer? How can I dispose this particular share? How can I realize money out of it? How can I make profit out of this transaction? So then people will not be interested. So it's very important that secondary market is nothing but, in simple word, it is called stock exchange. That is called secondary market, a place where you can get different numbers of buyers and sellers for different prices, and eventually you can offload the holding that you have bought in the IPO. And you can see in the secondary market below, it is both for debt market and for the equity market. I hope by now you are clear what is the meaning of the equity market and what is the debt market. Equity market in simple terms is nothing but stock market, or very commonly where people call it is share market. That is called equity market. Now we go just beyond capital market. There is a concept called money market. Next is money market. Again, for money market, we have separate slide, but in short, money market means any instrument which is issued for a period of less than 1 year. Those instruments are called money market. For example, of course, we'll discuss in the slide. For example, it is a T-bill, that is treasury bill, or short-term government security, or commercial paper, or call money. All this is part of the money market. So for the time being, you can just understand that money market instrument are those instruments whose maturity is not more than 1 year, whose maturity is within a period of 1 year from the date of its issue. Those particular thing is getting traded or are getting issued in the money market. The third is FX. FX is nothing but foreign exchange market. So foreign exchange market is a very big market. you again have a very detailed thing about FX market separately, but very interestingly, FX market is a market which is 24 hours working everywhere. It is not stopping anytime. It keeps on working 24 hours. Might be in some place it would be working by this and that time, other place it would be this and that time. But overall, if you see, FX market is active for the 24 hours, because you know that 24 hours different countries have different time zone, and anyone has to make payment at any point of time. So that is the reason that FX market is working. FX market does not mean, foreign exchange market does not mean just making payment. Even people may trade in the foreign currency. Even people may basically take exposure in the foreign currency derivative market. Even people can go for the hedging in the foreign market, that we will see in the derivative thing. And last is the derivatives market. So derivatives, very detailed study we have. Derivatives can be for stock market, derivatives can be for commodity market, and derivatives can be for foreign currency and even for interest rate also. And if you go to USA, country like USA, you will be surprised to know, in if you already know, it's well and good, but if you don't know, you'll be surprised to know, even weather conditions prediction is done through the derivative market. There are a lot of futures related to climate. So somebody can sell that I am predicting to today it will be heavy rain, or today it will be a sunny day. That also is basically a part of the derivatives market in USA, because it's a very, very matured market. India is a evolving market. It's not a matured market. Might be in future. Today we may surprise, but in tomorrow, tomorrow means in days to come, we will see that in India also we can have such kind of a product. Below you can see, when we talk about money market, all these items are given what are the money market instrument. Gradually we will see all this in detail also. So please understand, when we talk about the stock market is not an instrument. Stock market is a place. For example, let us say, let us go to a different place. I have vegetables and I have fruits. So vegetables and fruits are what? Instruments, because I'm selling them. If I am selling vegetable, so where I have to sell the vegetable? Either I will sell it online, or I will sell in an actual market, which is called a physical market. So it means that market is one thing, and in the market, what you are selling, that is another thing. So when we talk from the capital market point of view, if you're talking about bonds or share, what is this? This is similar to vegetables and fruits. It means you have to sell these particular things. But the question is, where are you going to sell them? So you sell them on the stock exchanges. So stock exchanges is nothing but, I can say, listen carefully, it's a platform for selling and buying these instruments. What are those instruments? Shares and bond. Now the question is, what is bond? So bond is nothing but company does not want to raise money through share, but the company says we want to borrow money from the public, and after a certain time we will return the money to the public. So when they raise money through an instrument where they want to return money in the future, that instrument is called as what? Bond. If you are taking money from the public temporarily and you will return it back, why somebody would give you money if you don't give them any return? So you will say, just as you keep your money in the bank, you get interest for that. So if you're giving money temporarily to us, if you're borrowing money from the public, we will also make certain particular interest to the public. And until then, until the maturity of that bond, let us say that the bond is for 10 years. So till the maturity of that particular bond, ultimately that bonds, if they are listed, then the person should not wait for the maturity. That person can sell that particular bond also on the stock exchange. So I will repeat once again. Stock exchange is not an item. Stock market is what? It is a place. It is a trading platform. It is the place buy and sell the share. And what is bond? It is an instrument through which you can raise the capital and people can invest in the bond for the purpose of getting a regular flow of income, which is in the form of interest. Or debenture, these days, you do not get anything in physical form. Have you ever seen that you're holding a few shares of any particular company in physical form? The answer is no. It means the shares are reflected in digital way. It is reflected in electronic way. Your demat account will tell you that you are holding 100 shares of Reliance Industries. You cannot see them. It just tells you in number. So where this digital transaction is done, or where these particular shares are digitally stored, it is stored in a demat account. In order to open a demat account, you have to go to the depository. So in India, we have principally two depository. One is called CDSL and NSDL. Once you get to a broker, let us say, I'm just taking for example, you are doing a transaction, say like with India Infoline. So India Infoline will ask you that, do you want to open a demat account? You will say, yeah, I don't have a demat account. Please open it. So once you open a demat account, that India Infoline will have a tie-up either with NSDL or with CDSL. There are only two DP, or we can say depository participants in India. Either of this particular will give you a platform to have a demat account. And in future, whenever you purchase the shares are ultimately getting credited to your demat account, because in practical life, neither the shares will be in your hand, neither the shares will be in the broker's hand. The broker will purchase on your behalf and ultimately it will transfer to your demat account. So that is basically the depository thing. Similarly, when you sell the shares will go out of your demat account and it will get credited to the person's demat account who has bought shares from you. It will get credited to that particular person's demat account. So in short, demat account is nothing but way of electronically holding the shares. Okay, so I move to the next part now. And now you can see on this particular slide, financial services. The first is called fund-based services. So what is fund-based services? One is called leasing, mutual funds, housing finance. This is fund-based. Fund-based means all these are nothing but there is a particular fund. Like for example, when we say mutual fund, so it is a collective pool of money that is basically called mutual fund. This is called fund-based services. What is fee-based services? Where there is nothing involvement of a fund. They give you some services and for that they charge you certain fee. The most common example is like broking operation. So in broking, what does the broker does? He does not have any goods to deal with. He will just say, okay, you take my trading platform, do the buying and selling, and for every transaction that you do through me, you will have to pay a certain brokerage fee. So in that case, this is just a fee-based services. Similarly, you can see portfolio management advisory services, portfolio management or advisory service. What does the portfolio manager does? He will charge you a certain fee. So there are two ways. One is called fund-based services. The most common example to understand is like mutual fund. And what happens in mutual fund? It does not charge you advisory fee directly. What does the mutual fund does? Mutual fund will run its operation. It will incur certain expenses. It will make some profit, and the profit will be reflected in the form of NAV. And if you get the higher NAV, you make a profit as compared to the purchase price. That is basically the fund-based process in the services. Moving further, now we know more about this. Already you can see all these things we have discussed earlier, but still now individually, what are these different participants? We will talk about that. So first is issuer. So I'll just have an entire slide here and then we can discuss about it. So first of all, when we talk about issuer, what is the meaning of the issuer? Any person or any entity which is issuing shares or which is issuing bonds, that particular entity is called issuer. So let us say that if Tata Technology tomorrow gives shares to the public, so it has become an issuer. Let us say Government of India raise money through bonds among the public. They say we have bought Power Finance Corporation bonds for 6 years. So who is issuer now? Government of India is the issuer. Let us say the bank says we want some short-term money. There is shortage of deposits in the market. So we want to raise some money through the bonds. So it means that what is the bank? Bank is nothing but the issuer. So in short, we can say that what is the role of the issuer? To raise the capital. Any person can be an issuer. It can be a private company, it can be a public company, it can be government, it can be some individual company. So any particular person can be an issuer. So they will have the responsibilities of issuer are as follows. Obligations of the issuer of security. Like for example, they say we have raised the bond. So for every bond that we have raised, how much interest we will pay? This will become the obligation. If they have raised shares, not the bond, then money raised through the shares, they will be under obligation to pay dividend whenever they make profit. So obligation means as a moral obligation, not a compulsory obligation, but a moral obligation that if the company makes profit, they will pay certain dividend. Reporting financial condition. Whenever a company gets listed on a stock exchange or whenever you issue shares or bonds to the market, ultimately there is a regulatory requirement that every quarter you will have to give a disclosure of your quarterly unaudited result, because results of the company are audited once in a year after the close of the financial year, but every quarter you will have to give a disclosure of unaudited financial result. So apart from that, there can be many disclosure, like for example, who are the directors of the company, who are the auditors of the company. If the company has raised finance, then they have to disclose how they have utilized that particular money. Let us say if I say I am raising 1000 crore and the purpose of raising 1000 crore money is this and this. Ultimately, after a certain period, you have to disclose whether you have utilized the money for that particular purpose or you have spent it somewhere else. So there can be many such things. I'm just discussing 2-3 things. You have to keep on timely reporting about many many things which is required as per the regulatory standards of that particular industry. And last is operational activities as required by regulation. Let us say if the company is into certain operation, for example, if the company say like into mining business, so basically in the gone by year or in by gone by quarter, how many tons they have extracted something from the mine, what have they done for the ecological balance or for the environmental clearance purposes, because they've extracted so much of coal, in which market they have sold the coal, whether they have realized all the particular sales in cash or there is something outstanding, if any particular litigation is there with respect to income tax or GST department, what is the outcome of that. So there can be many things which is related to the day-to-day operational activity that too has to be reported, apart from the general thing like what is the profit the company has made, how much loan company has borrowed, whether company has repaid any particular loan. All those particular things they have to show as per the regulatory standards. When we talk about further issues include, already I told you, but you can see here again, issues include government, issues include investment trust. For example, if you talk about the mutual fund, so mutual fund also issue. What the mutual fund issue? Mutual fund issue units. Mutual fund does not issue shares. What does the mutual fund issue? Unit. Whenever the mutual fund comes with any particular mutual fund for the first time, we do not call it as IPO. We call it as NFO, new public offer, or you can say new fund offer. Normally we say it is a new fund offer. So investment trust is nothing but, in simple words, as a layman, we can understand that we are talking about a mutual fund. And similarly, issues include private corporation, because companies are very, very prominently raising money either through issue of shares or through bonds, etc. And let us go. Issues can be, you can see domestic, international. So domestic means domestic company. If it is international, it can be international company. Let us say that suppose if there is a particular Indian company, an Indian company wants to raise money in USA. You may ask why in USA, why not in India? Because right now, let us forget, currently we are in a very exceptional situation. But 2 years back in USA, the interest rates were close to zero. So suppose if you want to raise money in USA as a private company, you were able to raise money at the rate of 3 to 4%. So if I think from US point of view, if Indian company is raising money in the US market, then it is which issuer coming to the market? International issuer. It's not a domestic issue, it's an international issue. So many times we raise money outside the country also because the cost of funding is quite less in the outside market. For example, just let us talk about the bullet train project in India. You know that the bullet train project is between Ahmedabad and Mumbai. I think to the best of my knowledge, it is between Ahmedabad and Mumbai. So now for this particular project, there is a lot of capital required, and this particular project is funded by Bank of Japan, or you can say by Government of Japan. More appropriate would be by Government of Japan for another 50 years. You know what is the interest rate? It is 0.5%. Not 1% also, it is just 0.5%. So it means we have raised this capital from an outside country. One government has raised capital from another government at 0.5%. So what kind of issue this is? This is an international issue because it is not within the country, it is outside the country. So this is an international issue. I hope the point is clear. When we talk about the demand side, so when we talk about the sell, so sell assets to get financing. So sell assets means what? If I sell shares in my company to the public, what I'm doing? I'm selling the asset. Till now, I had the complete ownership in my company. But if I sold 10% stake in my company, I'm selling the asset. Why? Because I'm having deficit funds. What is deficit fund? I'm having shortage of fund. I think that my company should grow, but for growing that particular company, some funds are required. What I will do, I will sell certain stake in my company. One very interesting example I would like to share. I hope if you are aware a little bit about the news, you will able to recollect it very nicely. During COVID time, when all the companies were getting slowly into problem because businesses were closed down, there was one particular big company in India, Reliance Industry, which actually completely repaid its debt. It was carrying a 1 lakh, you can say 1 lakh crore of debt in its books, and it ultimately paid that particular debt when the COVID started. When the COVID was first wave of COVID, when it came, I guess it was March 2020, and everyone was in problem. But this company ultimately became completely debt free at that time.
If you want to make a career in data science, then Intellipaat has IIT Madras Advanced Data Science and AI Certification Program. This course is of very high quality and cost effective. as it is taught by IIT professors and industry experts.
Basically, Reliance Industries ultimately took a loan of 1 lakh crore from the market for setting up a company's infrastructure for Reliance Jio. You know that Reliance Jio was a telecom company, that for that reason it took it. Now the question is that they wanted to repay that debt. If they don't repay that debt, they will carry the interest portion. If for 1 lakh crore, they will have to keep making interest payment, which will be in crores of rupees, which will reduce the profitability. So they sold a certain percentage of stake in this particular company in favor of, if you remember now, to Facebook owner. You know who is the Facebook owner. So to Facebook owner, basically they sold a portion of Reliance Industry, and whatever valuation they got, based upon that particular valuation, they ultimately were able to repay the loan of Reliance Industry. So this is the point that I'm telling. The company sold its asset. What was the asset? The ownership in the company, a very minor ownership in the company to an outsider, so that ultimately they get completely rid of that loan. Whether the management is still having ownership, yes, they are the maximum shareholder. They are the biggest shareholder in Reliance Industry. So it hardly makes difference for the day-to-day running of the businesses. They are still the biggest owner of the company, but ultimately today they are zero debt company. On the contrary, you can see that Adani has started piling up the debt. They are borrowing money. I think their borrowed money is in excess of 2 lakh crore. And today you see what is the share price effect. Whether it is because of Heidenberg or for whatever reason, 70% of the shares value have been wiped out. So the point is, ultimately, sometimes it makes sense that you sell your asset and get out of the loan cycle. You repay the loan so that you become quite light in terms of your payment obligation. That is the basic point that I wanted to discuss here. Let us say about the investor. Do you know what is investor? When we say any particular investor is buying shares of any particular company, what is the intention in his mind? So there can be only two intention. Either basically, if he's buying a particular bond of a company, then he just want to get interest income. So basically, he has only interest income intention. He just want to get a fixed interest. Somebody may argue, if interest is only the objective, then he can park the money in bank deposits also. In bank deposit, you will get lesser interest rate as compared to if you give your money to the company which is raising it in the form of bond. So suppose, if example, I'm not saying that exactly this is the interest rate. In today's scenario, if a bank is giving you 6% interest for 1 year fixed deposit, similarly, if you have there is another bond in the market, it can give you from 8% to 12% return. It depends upon the company profile, whether the company is good or bad. If the company financials are bad, it will have to pay more interest rate. If the company's financials is good, it will pay you less interest rate. That is a basic funda. If the company is very good, they will pay you less interest. If company is very bad, then it will have to get more interest to get the finance available. The second objective of the investor is, when the investor buys shares of a company, so there can be again two objectives. Buying the shares of a company, two objectives. One is get the shares in the IPO and just sell it for to make some quick profit. That can be one objective. Another objective is, if you want to create wealth over a period of time, which technically we call it as capital gain, then you will have to buy the shares of good company and hold it for considerable amount of time, and you will get sufficient wealth. So basically, if we go by the history, the maximum wealth is created in the equity market if you get good company shares and you hold it for very long term. If you don't hold it for long term, then you cannot create the wealth. So for creation of wealth, it is very important that you create for very long term. Somebody may say, if I keep my money in bank fixed deposit for very long term, then can I create wealth? No, in keeping money in bank deposit can only create interest income. It cannot create wealth. So what is the mean difference between wealth creation and between interest income? Interest income would be a fixed amount of 6%, 7%, 8%, 10%. But when we say wealth creation, it will not grow in percentage, it will grow in times, number of times. That my my investment of 10 lakh has multiplied by 5 times, 4 times, but not suddenly. It will multiply over a period of time because of the stock market factor. So that is the basic objective of the investor. You can see what are the goal. basically the capital gain. How to make a investment in any company? So basically, you have to rely on the fundamental analysis. There are a lot of fundamental analysis factor, like what is the price to earning multiple, what is price to book value, that we will see in a separate chapter. So based upon the fundamental analysis, you try to figure out whether a company shares is undervalued or it is overvalued. If it is undervalued, a very common thing, you will just buy the share to make some profit or capital gain out of it. If it is overvalued, you will not buy that particular company share. So that is a simple thing. Next, when we talk about market participant, the first one thing given is, unlike speculation, which is often short-term and active in character, buy and hold investing is passive over the long run. So there are two methods. One is like continuous churning the portfolio, buying and selling. So who does this activity frequently, buying and selling? Trader. Trader means what? Any particular person who has entered this capital market with the intention of doing some speculative activity. So these people are called trader. And there's another person who is an investor. So he bought some good multinational company stock or good blue chip company stock, say like Reliance or Tata or similar like that, and holding for 5 year, 10 year. So if this company will grow, and if you are an investor in this company, obviously your wealth will also grow. So it is like basically you are doing a kind of a transaction with Mr. Ambani if you are holding Reliance Industry share. If means that if the fortunes of Mr. Ambani will change in favor, or will improve for better, ultimately you are also owner in the company because you have bought shares in that company, so your fortune will also improve. Now how much it will improve, it depends how much you have invested in the company. If you have invested a significant chunk, the wealth will also grow significantly. If you have invested just very few number of shares, 5 share, 10 share, to that extent your wealth will grow. So it all depends what amount of participation you have done into the company. Next point, you can see they largely base the investment through fundamental analysis, already that we have seen. And the third is buy and hold approach, as its name implies, holds that investors will purchase stock ownership in a firm and hold on to these stocks for an extremely long period of time, typically measured in year. So whenever we hold investment, it is for n number of years. I have seen in my circle, particularly in my friend circle or in my relative circle, that people are holding shares since last 20, 30 years. Company shares like Hindustan Unilever, ITC, GlaxoSmithKline, Procter and Gamble, Nestle, Colgate Palmolive, Infosys, Wipro, TCS, Bata, all these particular company shares have grown over a period of time like anything. I personally, I can witness 2, 3 company shares. Like for example, I have seen Titan. I hope everybody knows Titan. Titan share I personally bought when I was in college days around 25 rupee. And I guess today that particular share price is around 2000 rupee. Might be it is like in 10, 15 years. I don't know the exact number here. So this is like from 30 rupees stock, it has grown to 2000 rupee. This is not income generation. This is called wealth generation. But suppose if I would have invested in FD, then it would not give me this kind of a phenomenal return. It will only give me a steady income. So it depends. You want a steady income or you want to multiply your wealth. Accordingly, you will take an exposure to the relevant asset class. Moving further, when we talk about the regulator, so you know what is the role of the regulator. So I'm not going as per line by line, but basic objective is there should be smoothness in the operations of all the companies which are operating in that segment. So just for example, let us say, I'll give my live example. Suppose few years back, there was one X company and I did not get the dividend from that particular company. So I wrote a mail to that particular company that you have declared dividend in this month. Now I am 4 months away from that particular time period and still I have not received that dividend in my bank account. I sent the mail, no reply. I sent a follow-up email, reminder email, still I got no reply. Then I went on the SEBI's website and I posted my grievance that I am not getting the dividend and no reply from the company management with regards to non-payment of dividend. Again, in next 15 days, I just got a reply to my email also, and the dividend was also credited to my bank account. The point that I'm trying to make is that because of the regulator, the investor can feel comfortable that ultimately in the market, if anything is happening not as per the practices or as per the norms or as per the rules and regulations, then regulator will come into picture and it will take care. So when we talk from banking point of view, basically the regulator is RBI, Reserve Bank of India. When we talk from the capital market point of view, the regulator is SEBI, SEBI, Securities Exchange Board of India. Let us say you are buying an insurance policy. So you have this particular doubt in mind that whether at the time of claim, whether the company will pay the claim or not, insurance claim will be settled or not. So if you have done everything perfectly from your side, you have not done anything wrong. If your claim is genuine claim and you have paid the premiums in time, then the company is bound to pay the claim. If it does not do that, then anyone can go to the regulator and regulator will take necessary action against that particular insurance company. So for every sector, real estate, pension fund, mutual funds, capital market, banks, foreign currency, commodity, every participant or every activity of the capital market is regulated by something or the other. And that gives a great confidence to the investing public that nothing wrong is going to happen with their hard-earned money. So that is the basic thing about that. So I could say in simple word, investor protection, proper rules and regulation, compliances, proper transparency, disclosure, good code of conduct. All these are very important when it comes to the regulatory part. Moving further, custodian bank already we discussed. So something here it is given in simple word. You can just read it out, but I will just explain in my simple word. So custodian banks usually are normal banks only, but sometimes it can happen that actually they are not into banking activity and they are still acting as a custodian. But usually if you see, for example, Citibank or say like SoftBank, these particular banks, they have commercial operation also and they have a separate custodian work also. So now you know what is custodian. Like they are basically safekeeping the assets on behalf of some entity. Somebody bought the share and instead of holding the shares with themselves, they have kept it with the custodian. So this has become the custodian. So custodian is that. So you can see on the right hand side, assets held in such a manner are typically owned by large institutional firm. So like you and I, if we are buying share, we are not keeping our shares with the custodian. We are keeping our shares in a demat account. But if it is a very big institution, say like mutual fund, pension fund, some sovereign fund, or let us say foreign institution investor, then they don't hold shares with them or in their individual demat account. They appoint a specific custodian, and the role of that particular custodian will be to hold these particular assets with utmost safety. And whenever it is required, then they will transfer it to the relevant person. So this is what examples are also given, like banks, insurance company, mutual fund, hedge funds, and pension fund. So that is about now. You can see on the screen brokers dealer. So just a brief about the brokers and dealer. Who are the brokers and the dealers? We have discussed enormous time. Basically, an entity which basically accepts order on behalf of the buyer and seller, and they give the platform to transact through their particular trading platform. So, just a simple example: I opened an account, let us say with Anand Rathi Stockbroker. So I will ask Anand Rathi Stockbroker either by calling or they will give me an online trading platform that I want to buy certain quantity of certain company share or I want to sell certain quantity of certain company share. This a particular activity of buying and selling, which is done through a particular broker. So broker will charge me a certain fee. Why? Because this broker is ultimately affiliated with a particular stock exchange. It is registered on a stock exchange and it is basically a broker of that particular exchange. And they have to pay a certain fee to that particular stock exchange. It is not that anyone can become a broker. There are certain eligibility norm. You have to become a broker. For that, you have to pay some annual fee. And now this particular broker has set up a lot of infrastructure, appointed employee, have a lot of surveillance mechanism, and he's accepting orders from the public. So in order to recover all these costs and to make a certain profit, the broker will charge you a certain brokerage. These days, the brokerages in India are very, very competitive. But earlier there was brokerage as high as 2% of the transaction volume. So suppose if I traded say like for 1 lakh shares, or not 1 lakh quantity, I'm saying 1 lakh value of share. So I will have to pay 2% of 1 lakh as a brokerage in olden days. Means I'm talking about when things were not online, when people used to transact physically by outcry. You can, if you have watched a movie called Guru, or in case if you have watched a particular web series 1992 Scam, which is available on Sony Live, then you can just understand how the transaction used to happen in those days on the floor of the stock exchange. People used to shout and say that this particular company shares like 1000 rupee, 500 rupee. If another person want to buy at higher price, then he will shout at a higher price. So that way it used to happen in those days. But now everything is basically electronically. And because of COVID, now many people have even started doing online trading or online investing instead of asking the broker by phone calling. Now they have started placing the order themselves by going online and ultimately logging in through the account and doing the transaction for themselves. So this is something about the broker and dealer. See with some pictorial presentation what is that particular thing. Here there is a client. The client goes to the broker and the broker ultimately places the order and the securities are traded. Now there is one concept called dealer or principal. What is a dealer? Dealer is nothing but a person who places your order into the system. Basically, when you say buy certain share or sell certain share, so this activity is done by certain person. That particular person is called as a dealer. That person will be called as a dealer. Technically, we call it as a dealer. So this is the meaning of the entire broker agent or a dealer activity. Yeah, you can say principal, but most oftenly in common language, we don't say principal, we say dealer. Similarly, here you can see broker and agent, but usually we don't say agent. Might be for our understanding, we will say agent. Normally, you will call in the entire India brokers only. Broker, sub broker. If there is another broker below a broker, we will call it as a sub broker. But there is nothing called agent. It is for understanding given. What is broker? Broker is nothing like an agent. It acts as an agent between the two entities, between the stock exchange and between the buyer and the seller. That is why that word agent is mentioned. But in day-to-day life, we use the word broker only. The next point you can see here, again through diagrams given, the regulatory bodies is there. Let us assume that the regulatory body for stock market is SEBI. Because for capital market, it is SEBI, Securities Exchange Board of India. Then we have exchange. With exchange, brokers are connected and ultimately the investor is connected through the broker. So ultimately, whenever the investor wants to trade or invest in any company, he will not directly go to the exchange. He will go through the broker. The broker act as an intermediary or as an agent. And at the broker level, there will be a dealer who will place your order if you are doing an offline transaction. If you want to do an online transaction, you do not want to take help of the broker, means you want to use the platform of the broker, but you do not want to call him and place the order. Then you will have your login credential. You can just place your login ID password and directly you can do the transaction yourself. In that case, one particular person is eliminated, and which is that person? It is called dealer, because dealer work is what? To place order on behalf of the client. That activity is placed. It is just like if you want to do the transaction in bank, either you can call the bank or you can visit the branch. That is called offline banking. But let us say if you're doing net banking, in that particular case, all the banking persons are eliminated, but you are using the platform of the bank. When you're doing internet banking, it is nothing but, suppose if you have an account with State Bank of India, you're using the platform of State Bank of India portal, but ultimately all the intermediaries within the bank, like cashier or say like any other person, that gets eliminated because you yourself are doing that particular transaction. The same thing happens in this particular trading account. Either you can do online or offline. Certain brokers will charge you more brokerage if you do an offline transaction, because in an offline transaction, you are taking help of a broker. So their resources are getting used because you call them. So if you call them, then whatever calls are made by the client, that has to be recorded and stored. So that has a cost. If you're calling him, then that particular dealer has to place the order. So there is a salary of the dealer. So if in certain cases, brokers will charge you more brokerage if you place order offline, but if you're doing on your own, then the brokerage will be far competitive in nature, because infrastructure is once created, online infrastructure, you are utilizing it, you are not taking any help of the broker's cost. So that is the reason of that. So this is a basic understanding. You can see here, buyer, whether if it is a buyer, he's also going to the broker. If it is seller, he's also going through the broker. And ultimately, whether it is a buyer's order or seller's order, both these orders ultimately goes to the stock exchange. Normally, it is said in a very lighter manner that whether the client makes profit or not, that is immaterial, but broker always makes profit, for the simple reason, once you have bought the share, you will sell the share. Now, whether you make profit or you make a loss, but the brokerage of the broker is always fixed. So it means the broker is always in a very good situation. He is not in a situation to make loss. He's in a situation to make profit only, because he's getting a commission. So not only the stockbroker, in any business, whenever there is an intermediary whose work is just to connect to someone and to get a commission, that particular person has nothing to lose. That person always makes some money only. That is the basically role of the broker. Moving further. Now you can see another thing, which is depository. Already I explained you, but more detailed discussion is there about the depository part. So if you remember, I told you, you can see here down, this is uncertificated or certificated basically into dematerialized form. In simple word, whatever shares were there earlier in paper form, in physical form, that has been converted into electronic form, and that is nothing what we call it as dematerialized. So this is like investors have their securities in the depository. Depository is nothing but a place where you open your demat account. In India we have two prominent depository, which is called CDSL and NSDL. I don't know about NSDL, but CDSL is already listed on the stock exchange also. And below it is mentioned here, the transfer of ownership through a book entry rather than the transfer of physical certificate. So here you do not actually physically transfer any certificate. Whenever shares are credited to your account, you get a particular book entry. That is, something is visible in your particular statement of account that you got this much of shares credited to your account. Similarly, whenever the shares move out of your account, you will get a SMS that the from so and so shares have been debited from your account. Just like in bank, whenever it happens that you have made a payment through check to someone, and whenever that particular check hits your account, you get a message that your account is debited by this when this much. So you cannot see the money in your bank account. Can you see the money that this is a currency note? No. But the money is there in electronic form. Money you can, whenever you're doing internet banking, etc., you can see the money in electronic form. The same thing is here. If unless and until you want to convert this particular share into actual physical form, so far that particular shares will remain in digital form only. So suppose if you want to convert the share into physical form, which no one actually does, practically it is not viable, then that process is called as rematerialization, because again you are converting that into physical material. So we call that as rematerialization. I have personally never seen in my life that any person is doing rematerialization, but I have seen that all the people who were holding physical certificate, they have get it done a dematerialized, that is converted into the digital certificate. You can see the only difference here is investor A, investor B, investor C. What happened? Once you sell the security to another investor, the shares or the securities will move from the investor A demat account and it will go to the investor B account. If tomorrow investor B sells it, it will go from investor B to investor C account without physical traveling. It will get digitally transferred from one particular bank account, from one particular depository account to another depository account, or from one demat account to another demat account. That is the meaning of this particular part. So you can see at the bottom, you can read something. It enables brokers and financial institutions to keep their securities in one place. This is only the one important thing. Whatever securities are there, you are not holding that securities with yourself. You are not holding those securities with the broker, but that particular security is kept with another independent institution, which is a depository, and that depository is giving you this demat services and your shares are held there. So let us say that suppose if I'm having my shares in a particular CDSL account, and let us say tomorrow something happens to a particular broker, that particular broker is problem. So whether you will suffer because of those particular problem? No. Why? Because your shares are not with the broker. Your shares are separately in a different demat account. So even if the broker have any particular problem, you will not feel the pinch of that particular transaction because your shares are now in safe custody. So it is like just we keep with custodian. This is not called custodian, but it is acting like a custodian only. Demat account is nothing but it acts like a custodian only. So your assets are completely safe there. Whether the like capital market, like when we say about capital market is regulated by SEBI, so whether these demat accounts are also regulated by SEBI, answer is yes. Every particular entity which comes within the domain of capital market, that's get regulated by SEBI. For example, we studied registrar and transfer agent. Regulated by SEBI, answer is yes. Depository regulated by SEBI, the answer is yes. Brokers regulated by SEBI, yes. Mutual funds regulated by SEBI, yes. Stock exchanges regulated by SEBI, yes. It means all these intermediaries or participants which are connected directly or indirectly with the capital market activity, they will be ultimately regulated by the SEBI. There will be certain things which can be regulated by SEBI also and which can be regulated by RBI combined also. For example, if it is an international mutual fund. What do you mean by international mutual fund? A mutual fund which is collecting money from Indian public but not investing in India. It is investing abroad. At the time of offer, they have made it very clear that whatever money we accumulate in India or get it from the public in India, we will invest in the US market. This is a fund which is dedicated for the US Nasdaq market. So it means you will have to invest in foreign currency, and foreign currency is a subject matter of RBI. So in this particular case, the mutual fund is subject matter of SEBI, but currency is a subject matter of RBI. So two regulatory bodies will come into picture, RBI plus SEBI. So there will be certain instances in day-to-day life where not single regulatory body will control, but there can be two regulatory bodies which are controlling. Let us take another example. I hope that would be quite interesting to you. There is one particular company which is into real estate business, and it is listed on the stock exchange. So as far as the stock exchange part is concerned, regulated by SEBI, but since it is the real estate company, let us say if it is Parshvanath Developers, or if it is Macrotech, or if people maximum are from South. So I hope you must be knowing Prestige. The Prestige is there, DLF is there, Hiranandani is there, Brigade Enterprise is there very much in Bangalore. So all these particular company, since they are dealing in real estate, apart from SEBI, they will also be governed by another regulator which is for the real estate, and that is called Real Estate Regulatory Authority, RERA. In short, we call it as RERA. So sometimes it will happen depending upon the nature of business transaction. Multiple regulators can also come into the picture. So now we have clearing agent. What is clearing agent? You know already. I have explained you, but just a basic idea. Suppose whenever we do a transaction, there are two possibilities. Just you can see below this particular blue line, transactions undertaken may be executed on a futures exchange or a security exchange. For your understanding as of now, just understand, either you can do the transaction on a stock exchange. For example, I want to sell, say like a Reliance Industry share, and I want to sell it on the stock exchange. So this is the first part. The second part is over the counter market. Now, what is this over the counter? I am not selling on the stock exchange. You wanted to purchase Reliance share. You are one of my good friend, and I also want to sell it. I say, why to go and sell it on the stock exchange? Because ultimately there I will require 1 day to get the price. Broker is involved, so I'll have to pay the brokerage. I'll sell it directly to you, and the shares I'll transfer from my account to your account. So this kind of a transaction, which is over the counter, two things you have to keep in mind. First of all, this is a off market transaction. I'm not saying offline and online. Don't get confused with this. Off market. What do you mean by off market? You have not routed this transaction through the stock market, but you have initiated this transaction directly with the other party. So this transaction is called off market transaction. Whether the shares will be similarly transferred, yes. While transferring the share, you have to fill up a separate slip, which will be for off market transaction, and hand it over to your depository. Based upon that particular slip, the depository will transfer the shares from your account to the buyer's account, whose name and details you have mentioned in that particular slip. So this is called a basically off-market transaction. Now, one of the disadvantage of the off-market transaction is that there can be a possibility of counterparty risk. What is counterparty risk? You said, I'm selling the shares to you, you make me the payment. The other party says, okay, give me 2 days time. You give the shares to me, and I'll give you the payment on this coming Friday. And on the coming Friday, he does not give payment. Can I take any legal remedy against this person? Answer is no. And if at all it is there, it is a very, very long consuming process. But let us say if you would have done this transaction on the stock exchange, and might be on the stock exchange, some X party has purchased those shares. And even if that particular party has defaulted on the payment, still you will get the payment, because stock exchange is ultimately acting as a settlement platform also, which means that there is a separate fund which is called settlement guarantee fund. What it is called? Settlement guarantee fund. So even if one of the party defaults in the transaction, it is the responsibility of the stock exchange to honor the commitment through the money available in the security settlement guarantee fund. Question is, from where they get the settlement guarantee fund? Every transaction which you do, and when you see the contract note, on the contract note, there is a particular charge which is called exchange levy. You will find that particular thing in your contract, exchange levy. So within your contract, there is a brokerage, there is a tax called security transaction tax, there is another tax which is called stamp duty, there is one particular thing which is called exchange levy, which is very, very minor amount. In lakhs of rupees, you will find 1 rupee or 2 rupee of exchange levy. So this 1 rupee, 2 rupee, which keeps on getting accumulated, that goes into this particular fund. And if any of the party by chance defaults, normally it won't happen that anyone is defaulting, but by chance in the very remotest activity, if it happen, in that particular situation, the funds will be settled. So this is called the basic difference between the doing transaction at the stock exchange and the off-market transaction, which is also known as over-the-counter transactions. Over-the-counter means between the two person mutually, where the risk technically is known as a counterparty risk. Remember this particular word, the risk is nothing but the counterparty risk. Now you can see this particular slide and just understand the flow of diagram. So what is the clearing? You can just understand the buyer ultimately buys the security. If he's buying the security, he has to give the payment. Who is going to give the payment? Seller, because seller is ultimately selling the shares, so seller has to receive the payment. So buyer buy the security, buyer gives the payment. Now buyer, when it gives the payment through the broker directly does not reaches the end customer. It first goes to the clearing agent. So there are certain clearing houses. The payment will go to the clearing house. From that particular clearing house, the payment will ultimately go to the seller, and the seller will sell the security. So this security will go to the clearing house, and from this particular clearing house, the security will be delivered to the buyer. So in simple word, in any particular transaction, two things will happen. I will deliver the good, and for delivery of that goods, I need the payment. So both the transaction, that is delivery of money and delivery of good, it does not happen directly between the party. If it is happening between the party, obviously, it is called the over the counter transaction. But since this is through the exchange, ultimately both these things will go to the clearing house, and through the clearing house, the things will be transferred to the corresponding party. So if I am the seller, I have to deliver the security, and if I am the basically delivering the security, I have to receive the money. If I am a buyer, I am supposed to receive the security, I have to pay the money. So whatever you have to do, the discharge of obligation is done through the clearing house. Whether it is stock market, whether it is some other market, whether it is a banking transaction, in all this particular activity, there is a particular concern which is called clearing house. Only when there will be modern systems of finance through blockchain technology, at that time this clearing house mechanism gets completely eliminated. Unnecessary confusion will come up, but in future you will find that clearing house requirement will get completely redundant. It will be completely eliminated. But as of now, you have that clearing house mechanism. I can simply tell you what is the role of the clearing house: verification of the transaction and accordingly fulfilling the obligation. So what is verification of the transaction? If I sold the shares, let us say 100 Reliance Industry, so then ultimately the clearing house will check whether actually it has received 100 shares of Reliance Industry from Mr. X. If it is received, it will say, yeah, one part of the transaction is done. This one part of the transaction technically is known as one leg of the transaction. We have legs to walk now. So in securities market, we say that this is one leg of the transaction. So one leg of the transaction is over. Now, what is the second leg of the transaction? Somebody else has bought this particular share, so he has to give the payment. So the clearing house will check whether we have received the payment from that particular person. If the person has given that particular payment, then this security will be transferred to the buyer. This is called the role of the clearing house. This is not the role of the broker. What is the role of the broker? Broker only provides you the platform for doing the transaction. But once you have done the transaction, then this settlement of transaction takes place through the clearing house. So you have to be very clear what are the two different roles between the broker as well as between the clearing house. No, a clearing house basically is nothing. A clearing house, which is basically, I think, national clearing house, something, I don't know the precise name. So there are not multiple entity. For example, if we have brokers, there are multiple broker. But when we talk about a central bank, we have just one RBI. So similarly, when we talk about clearing house, there is not multiple clearing houses. There is one national clearing house or something like that. That single clearing house for the capital market will take take care of the entire settlement and clearing mechanism. So not multiple clearing houses would be there, just like brokers.
If you want to make a career in data science, then Intellipaat has IIT Madras Advanced Data Science and AI Certification Program. This course is of very high quality and cost effective, as it is taught by IIT professors and industry experts.
Now let's understand who is an investment banker.
A highly trained professional who provides a variety of financial services to businesses, governments, and investors is known as an investment banker. They assist businesses in obtaining business loans, issuing stocks and bonds, setting security prices, raising stock capital, allocating resources, negotiating mergers, and managing investments. They serve as the intermediary between private and public companies and investors. They would provide financial advice and consultation on the types of securities to issue, such as stocks and bonds, when and how to issue them, and what price to set for each security. Various financial transactions and investment ventures. They usually work in groups of managing directors, vice presidents, associates, and analysts, with each group covering a different industry or market sector. They are typically responsible for the following tasks: gather relevant information for financial decision making by researching and analyzing various market reports and databases. Second, monitor the current investing environment, identify risks associated with specific projects, and advise clients on how to proceed. Every day, perform company valuations, financial modeling, and financial metric calculations to forecast company performance. Assist companies with the issuance of securities, the management of initial public offerings, and the determination of initial stock prices. Finally, ensure that legal rules and regulations established by financial regulatory agencies are followed. So let us look at the types of investment bankers. Investment bankers assist companies, governments, and other entities with large, complex financial transactions. According to their work, the industry is flooded with large and small investment bankers. An investment banker's professional career follows a fairly standard path. Some of them are as follows. First, investment banker analysts. They are professionals who work in industries such as finance, healthcare, manufacturing, and emerging markets. Their role is to speak with company executives and investors in order to build cases for or against investing in specific companies or industries. Second, investment banker associates. They act as a middleman, creating and formatting slides, arranging client meetings, and performing financial analysis. Then we have VP investment banker. They meet with directors and managing directors to determine what they want and translate it to actionable tasks. He or she also builds relationships with new potential clients, at least as the VP advances to the SVP director level. Lastly, director investment banker. They meet with new companies that may become clients in the future, listening to their concerns and answering their questions. They also meet with private equity and venture capital firms to discuss their portfolio companies and which ones may need to be sold, listed on the stock exchange, or raised capital. So coming to the main part of this video, how to become an investment banker. After completing your 10 plus 2, first, earn a bachelor's degree. A 3 or 4 year bachelor's degree is required to obtain an entry-level position with an investment bank. Bachelor of Commerce, Bachelor of Arts in Finance, Bachelor of Arts in Economics, and Bachelor of Business Administration in Finance are all available. While each program's curriculum varies, you may study mathematics, accounting, economics, financial management, corporate finance, investment, taxation, data analytics, and business administration. Second, earn your master's degree. For investment bankers, a 2-year Master of Business Administration in Financial Management is a sought-after postgraduate degree. A Master of Science in Finance is also an option. The National Stock Exchange Academy offers 6 to 9-month postgraduate programs in investment banking and capital markets, banks and financial planning, business analytics, and management accounting. Third, obtain a doctorate. A PhD in finance and banking may require more than 55% postgraduate marks and a cutoff percentage in the UGC net. Asset pricing theory, corporate finance theory, research methods in finance, foundations of business research, and market microstructure may all be covered in the curriculum. The course lasts 3 years. Fourth, obtain a certification. A chartered financial analyst professional certification can help you advance your career. The CFA program provides intensive and practical investment and financial training. Economics, corporate finance, derivatives, equity investments, alternative investments, financial reporting and analysis, and quantitative methods can all be studied. After completing your bachelor's degree, you can apply for this program. The course can last anywhere from 1 to 4 years. Fifth, look for an internship. Investment banking internships can be found on online job sites as well as through campus placements, networking, and HR consultancies. Internships in investment banks can last anywhere between 2 months to 2 years. You can learn to improve your communication, presentation, and negotiation skills in addition to financial training. You may be offered a permanent position as an investment banker based on how well you perform during your internship. Finally, look for a job. You may receive a job offer immediately following your internship, through a campus job interview, or by applying to open positions with investment banks and financial advisory firms. Review your fundamental finance concepts, financial modeling, and private equity to prepare for your interview. It can also help to compile a list of frequently asked interview questions and practice answering them. So let us look at the skills required to become an investment banker. A good investment banker aspirant should have a strong analytical mind as well as the ability to work as a part of a team. They should also be able to think critically and be willing to learn new things. Some of the skills include arranging financing, equity financing, underwriting deals, analytical skills, negotiating mergers and acquisitions, structuring and closing principles. So what are the benefits of career as an investment banker? Investment bankers, like any other profession, have a variety of perks and benefits. This is considered to be one of the most lucrative professions in the world. Some of the advantages of working as an investment banker are as follows. First, salary. Depending on experience, an investment banker can earn between 5 and 8 LPA. They can open their own organization and make executive decisions for the firm as they gain experience and knowledge. They can also work as a freelance investment banker for a variety of companies and organizations. Second, job security. Professional investment bankers can work from anywhere in the world thanks to the skills they gain through practice. If they have a perfect skill set in the relevant field, they can easily get a job anywhere in the world. Third, positive career impact. Investment bankers assist financial markets and the economy by connecting sellers and investors. As a result, their actions improve the market development and have an impact on business growth, which benefits the economy. Fourth, higher education. While working as a professional investment banker, they can pursue master's or PhD programs in a related field. Candidates should be able to conduct research in investment and related fields. They can also publish their thesis for those aspiring to be investment bankers. Finally, unique experience. Investment banking is a unique field of business management in which people can work according to their abilities and knowledge. They also gain a lot of experience because it's a continuous learning process where you learn a new strategy and technique every time. What is the importance of investment banking in India? Investment banks use trained bankers to execute transactions in order to maximize revenue. Investment banks serve as a link between large corporations and investors. An investment bank's primary role is to advise governments and businesses on how to meet their financial needs and obtain financing. The following are the importance of investment banking firms in India. First, role as an advisor. Raising capital funds is a time-consuming task for any organization, which is where the assistance of an investment bank comes in. An investment firm can assist in the sale of the company's stock by determining a fair price using sophisticated financial models. While selling shares, financial analysts consider the factors such as earning potential and the strength of the management team. Investment banks provide advice during merger and acquisition transactions by advising management on the value of the company and assisting in its restructuring. Second, underwriting stocks and bonds. Underwriting is the process by which investment banks take financial risk in exchange for a fee. It entails conducting research and determining the level of risk involved in the insurance industry. An investment bank purchases a predetermined number of bonds or stocks and resells them through an exchange. The investment bank is responsible for preparing the documentation that must be submitted to the Securities and Exchange Commission before the company can sell any shares. Financial statements, management information, current ownership, and future plans will all be included in the documentation. Third, other functions. In addition to advising and assisting companies in raising capital, investment banks perform research, trading, and sales, asset management, wealth management, and securitized products. So how much do investment bankers make in a year? An investment banker's annual salary in the United States is $597,078. Your salary will depend on where you live, your level of experience, and other factors. The national average salary for an investment banker is 12,21,706 rupees in India. Investment bankers who have graduated from prestigious universities or work for large banks may have higher base salaries and good bonuses.
Now let's learn the career path of investment banking.
Investment banking is a fast-paced and highly competitive field that involves companies raising a capital by issuing securities and providing financial advice to the clients. Investment bankers typically start out as analysts and work their way up to become associates. Analysts are responsible for performing financial analysis and modeling, while associates and vice presidents take on more responsibility for client management and deal execution. We will see their responsibilities in detail in the next few slides. The entry-level position for an investment banker is typically an analyst. Analysts typically have a bachelor degree in related fields such as MBA or finance and also have strong analytical and communication skills. They are responsible for performing financial analysis and modeling for clients as well as assisting with the execution of deals. They work closely with associates and vice presidents to help identify potential clients and provide support throughout the deal process. A person may be elevated to associate status after serving as an analyst for 2 to 3 years. Associates are in charge of managing teams of analysts and handling additional responsibility for client management and deal execution. They should also be more knowledgeable about market and industry trends. After several more years of experience, an individual may be promoted to vice president. Vice presidents are responsible for leading teams of associates and analysts and for managing relationships with key clients. They also play a key role in business development and are responsible for identifying new business opportunities and closing deals. I hope the career graph from ground to up regarding investment banking is clear to you all of you guys. Now we shall look into the responsibilities of different designations for management consulting. If I talk about a management consulting, the first role is analyst. The entry-level position for a management consultant is typically an analyst or an associate. Analysts typically have a bachelor degree in related fields such as business or economics and have very strong analytical and communication skills. They are responsible for conducting research, analyzing data, and developing recommendations for clients. They work closely with managers and directors to help identify the potential clients and provide support throughout the consulting process as well. An individual may be promoted to manager status after serving as an analyst or associate for 2 to 3 years. In addition to managing teams of analysts and associates, managers are also in charge of overseeing projects and managing clients. They should be also more knowledgeable about market and latest industry trends. A person may be promoted to director after gaining more experience. Directors are in charge of managing relationships with important clients as well as managing teams of managers and analysts. They are in charge of finding new business possibilities and concluding deals, and they also play a significant part in business development. Now we are going to discuss the difference between investment banking and management consulting. So we are going to look on the following points. First is everyday task, then skill sets. Moving ahead, we will discuss about their salaries, and finally about culture and lifestyle. So let's start with everyday task. Everyday tasks for investment banking involve advising and assisting companies and governments in raising capitals through the sales of securities such as stocks and bonds. Another task can be underwriting and arranging sales of securities to investors, as well as providing other financial services such as merger and acquisition advice, and financial and strategic advice to companies or governments. The work often focuses on short-term projects and transactions such as initial public offerings or mergers and acquisitions. Investment bankers tend to be more focused on financial analysis and modeling, as well as strong negotiation and communication skills. If I talk about management consulting, the management consulting involves the following tasks. First is providing expert advice and assistance to organizations to help them improve their performance and achieve their goals. Their work also focuses on long-term strategic planning and problem solving, often involving a wide range of business functions such as operations, finance, and marketing. Management consultants tend to be more focused on strategic thinking and analysis, as well as possess strong communication and project management skills. They are often hired for long-term engagements during which they will work with a company to identify the areas of improvement and develop solutions to address those issues. In both management consulting and investment banking, advancement is frequently determined by combination of performance, networking, and experience. Both disciplines demand a tremendous amount of effort and devotion and are very competitive. The benefits, however, might be great for those who are up for a challenge. Now we will see the skill sets required for these two job profiles. Investment banking and management consulting are two highly competitive fields that require a specific set of skills to be successful. We will differentiate these skills into technical and soft skills. If I talk about the technical skills, for investment banking, strong analytical and quantitative skills are essential. Investment bankers are able to analyze financial data, create financial models, and make informed recommendations to clients. Strong financial modeling skills in Excel and proficiency in other financial analysis tools such as Bloomberg and Capital IQ are important. Additionally, investment bankers must have excellent communication skills, both verbal and written, to be able to effectively present ideas and negotiate deals. For management consulting, strong analytical and problem-solving skills are essential. Management consultants must be able to analyze data, develop recommendations, and implement solutions for clients. Strong research and data analysis skills are also important, along with the ability to create and deliver compelling presentations. With that, we will move over to the soft skill part. If I talk about the soft skill required for investment banking, in addition to the technical skills, investment bankers should also possess strong interpersonal and leadership skills. Investment banking is a term-oriented field, and investment bankers need to be able to work well with others and lead teams of analysts and associates. Strong project management skills are also important to keep track of multiple deals and deadlines. In addition to the technical skills, management consultants should also possess strong interpersonal and communication skills. Management consulting is a client-facing field, and consultants must be able to build strong relationships with clients, communicate effectively with them, work collaboratively with the team. Strong project management skills are also important to keep track of multiple projects and deadlines. Now we will discuss the salaries. The starting pay for entry-level positions in investment banking typically ranges from 6 LPA to 8 LPA annually. For experts with greater expertise, this can rise up to 25 LPA or more. The starting pay for entry-level positions in management consulting typically ranges from 4 LPA to 6 LPA annually, where for experts, this can rise up to 20 LPA or more. Bonuses, which may be large, always play an important role in defining the total package. Salaries for investment bankers are usually higher than for consultant managers, but this statement has to be considered by the company you are working for. Sometimes a company provides better work culture than the package. Also, the variable salary, that is bonuses, are awarded based on your personal performance. Your interest matters while choosing a job domain, not only the package. Now, we will discuss about culture and lifestyle. Investment banking and management consulting are both fast-paced and high-pressure work environments with demanding schedules. Investment bankers often work long hours, including evenings and the weekends, to meet the tight deadlines associated with completing deals and transactions. They are also expected to be available to clients and colleagues all the time and have to be able to think on their feet and make quick decisions. It requires individuals to be highly skilled, analytical, and able to make quick decisions and communicate effectively. Both fields are merit-based with opportunities for advancement and career growth for who can perform well. Now, we will discuss about how you can decide which career choice is best suited for you. As a strong case for consulting can be made if you want to work on a wider range of projects in a more civilized workplace. If you wish to stay in consulting or advance into strategy at large organization, don't mind the lower salary, then consulting might be a good option for you. A bad justification for consulting that can be there is very strict deadlines, which imply long working hours. A good case for banking can be that you want to work for on MAA, which is mergers and acquisitions, projects from beginning to end. Get the opportunity to develop efficient networks. Also, if you want to use the experience to transfer to a private equity company that specializes in particular strategy, then investment banking is the way to go. Bad justification for banking can be hectic workplace, culture, long hours, and monotonous tasks. Understanding the trade-offs and selecting the area where the benefits outweigh the drawbacks depending on your preferences will help you make a solid choice. If you comprehend it, you might be one step closer to resolving the age-old conflict between management consulting and investment banking.
And lastly, we have interview questions. What are the three financial statements?
What are the three financial statements? First is income statement. The income statement is a financial statement that shows the profitability of the company. It begins with the revenue line and works its way down to net income after various expenses are deducted. The income statement is for a set period of time, such as a quarter or a year. Second is balance sheet. The balance sheet does not cover the entire period, but rather provides a snapshot of the company at a specific point in time, such as the end of the quarter or the year. The total number of assets and liabilities must always equal the total amount of equity and liabilities. Third is cash flow statement. A cash flow statement is a magnified version of the balance sheet's cash account that accounts for the entire period, reconciling the cash balance at the beginning and the end of the period. Next question is, what is the difference between enterprise value and equity value? So enterprise value is the company's overall current value, whereas equity value is the value of the company's shares and loans, which can provide an indication of the company's current and future value. Third question, what is beta and how to calculate beta for a company? The beta of investment security is a measure of its volatility of returns in comparison to the market as a whole. It serves as a risk indicator and is crucial to the capital asset pricing model. A higher beta means a greater risk and higher expected profits for the company. Because 1 is the benchmark for beta, everything above 1 is more variable and carries more inherent risk. Next question, what is the difference between a merger and an acquisition? A merger is a combination of two or more commercial companies to form one joint entity with a new management structure, ownership, and name that capitalizes on its competitive advantage and synergies. In contrast, an acquisition occurs when a financially powerful entity acquires all or a portion of the total shares of a less financially powerful commercial firm. Next, what is DCF? The term discounted cash flow refers to a valuation method that determines the value of an investment based on its expected future cash flows. The purpose of a DCF analysis is to determine the current value of an investment based on projected future earnings. It can assist those deciding whether to acquire a company or buy securities in making the decisions. Discounted cash flow analysis can assist business owners and managers in making operational and capital budget decisions. Next question, how do you value a company? A company can be valued in three ways: comparable company analysis, discounted cash flow analysis, and precedent transaction analysis. First, comparable company analysis. It entails locating companies that are similar to the one under consideration and comparing their EBITDA, stock price, and price to earnings among other variables. Next is DCF. The discounted cash flow analysis uses the amount of money that the company is expected to make in future, discounted to present values. Finally, precedent transaction analysis. Precedent transaction analysis is similar to comparable company analysis, in which you look at how much similar companies have sold in order to determine the value of the company you're valuing. Next question, how do you calculate terminal value? Terminal value is the estimated value of a company after a certain period of time and is a key component of DCF analysis. There are two methods for calculating terminal value. First, the growth in perpetuity method and the exit multiple method. The growth in perpetuity approach assumes that cash flows will grow at a constant rate indefinitely. The exit multiple approach does not assume perpetual growth, but rather examines the net value of a company's assets at a given point in time. It is used to describe a company that will be acquired or liquidated in the future. Next question, when should a company issue debt instead of equity? Because the cost of debt is typically lower than the cost of equity, there are many situations in which issuing debt makes more sense than issuing equity. Issuing debt rather than equity makes sense if the company can benefit from the tax breaks by issuing debt, the company has consistent cash flows and can pay interest. As a result, the WACC is lower, and with more financial leverage, the company can get a better return on investment. Next question: what is the PEG ratio? The PEG ratio is an abbreviation for the price earnings growth ratio, which includes the PE ratio as well as the EPS growth rate of a company. Rapidly growing stocks have higher PEG ratios, whereas conservatively priced stocks have the same PE and PEG ratios. If a company has the same PE and PEG ratio, one could argue that its stocks are overpriced when compared to companies with the same EPS but a lower PE rate. Next question: what is net working capital? Net working capital is the amount of money a company has after paying off all current short-term debts. So it is given by current assets minus current liabilities. So current assets include balance sheet items such as accounts receivable, inventory and prepaid expenses, whereas current liabilities are short-term debts such as accrued expenses, deferred revenue and accounts payable. Now we're going to look at investment banking intermediate interview questions. Starting with the first one, what does negative working capital mean? When a company's existing liabilities exceed its current assets, it has negative working capital. This means that liabilities paid within a year outnumber monetizable working capital during the same time. Buyers frequently regard a target company's negative working capital as negative because it represents the additional capital required to operate the company after the transaction is completed. A buyer prefers a working capital ratio of 1 to 1.5, which means at least $1 in current assets for every $1 in current liabilities. This gives the buyer confidence that the company will be able to meet the sellers and payroll obligations in the short term. Second question: what is the difference between cash-based accounting and accrual accounting? So cash-based accounting records revenue and expenditures only when cash is received or spent. Accrual accounting, on the other hand, records revenue when it is reasonably certain that it will be collected and expenses when they are incurred rather than when cash is actually spent. Because credit cards and lines of credit are so widely used for payment these days, most large organizations use accrual accounting. However, very small businesses may choose to use cash-based accounting to simplify their financial statements. Next question: two companies are identical except one has debt and the other does not, which will have a greater WACC. The company with no debt will have a higher WACC because debt is less expensive than equity. Debt interest is always tax deductible. Debt is ranked above equity in a company's capital structure, which means that debt holders would be paid first in the event of bankruptcy or liquidation. Contrary to popular belief, debt interest rates are typically lower than equity cost of equity figures, which are typically higher than 10%. As a result, the cost of debt component of WACC will account for a smaller portion of the total than the cost of equity component. Fourth question: give an example in which you encountered a difficult situation while working in a group. So you can frame your answer in a way by saying, during my senior year internship in financial management, I worked in a variety of small groups. Each student had a very busy schedule, and I took the initiative to help everyone reprioritize their schedules and find areas to compromise. This aided in the group in balancing workload and work quality. In the same situation, there was a member of the group who was not carrying out his responsibilities, and I contributed to the solution by assisting him in discovering his strengths and allowing him to focus on them while the others filled in the gaps. Next question: what is terminal value and how do you calculate it? So terminal value is the value of a company, project or asset after a period for which future cash flows can be predicted. So terminal value assumes that a company will continue to grow at a certain rate indefinitely after the projected period. The terminal value is calculated using the following formula, where FCF stands for free cash flow for the last forecast period, G stands for terminal growth rate, and D stands for discount rate. Sixth question: how is the balance sheet adjusted in an LBO model? The additional debt is first added to the liabilities and equity sides, and then the shareholders' equity is wiped out and replaced with the maximum equity contribution from the private equity firm. After cash on the assets is adjusted for and any cash is used to fund the transaction, goodwill and other intangibles are used as a plug to make the balance sheet balance. Depending on the transaction, there may be additional implications such as adding capitalized financing costs to the asset side. Moving on to the seventh question, what is the difference between high yield debt and bank debt? Some of the major differences are: high yield debt has a higher interest rate than bank debt. Bank debt interest rates are not fixed like high yield debt rates. They fluctuate based on the Fed interest rate and LIBOR. Maintenance covenants apply to bank debt, whereas incurrence covenants apply to high yield debt. The main difference between the two is that incurrence covenants prohibit you from taking certain actions, whereas maintenance covenants require you to maintain a certain level of financial performance. For example, the debt or EBITDA ratio must always be less than 5 times. And finally, in case of bank debt, the principal must frequently be amortized over time. However, in the case of high yield debt, the entire principal is payable at maturity. Eighth question, determine if an acquisition is accretive or dilutive. So this is an important question whenever a company considers acquisition. Fundamentally, any transaction that increases the buyer's earnings per share is accretive. Any transaction that reduces the buyer's earnings per share is dilutive. So here's a quick rundown of how to respond to this question. Inquire your interviewer if the deal is all stock, and if the transaction is all stock, it is simple to determine whether it is accretive or dilutive. It is accretive if the buyer has a higher PE ratio. It is dilutive if the seller has the higher PE ratio. Ninth question, what is an LBO and what are its value drivers? A leveraged buyout is a debt-financed acquisition, typically a very high percentage of debt. The following are the primary drivers of an LBO's success or failure. First, the cost of acquisition, then the amount of debt used and the debt cost, and finally the anticipated exit price. It is also worth noting that the actions taken by the acquiring firm to increase the exit price of the target business have a significant impact on the success of an LBO. Successful LBOs, for example, typically involve expanding or restructuring the business to increase its value. 10th question, what is the difference between goodwill and other intangible assets? When a company is purchased, a goodwill premium is paid over the fair value of assets. As a result, it is linked to a company or business and cannot be purchased or sold on its own. Other intangible assets such as licenses and patents can be sold and purchased separately. Moving on to investment banking advanced interview questions. Starting with the first question, what is the distinction between capital and operating leases? Operating leases are used for short-term leasing of property and equipment and do not involve any ownership. Operating lease expenses are shown on the income statement. Capital leases are used for long-term items to provide the lessee with ownership rights. They depreciate, require interest payments, and are classified as debt. Second question, explain an IPO valuation for a firm that is about to go public. We only consider comparable public company IPOs as opposed to traditional valuations. We choose comparable public companies, apply the most relevant multiple, and base our estimate of the company's enterprise value on that multiple. We can calculate the equity value by working backwards from the enterprise value. We also consider IPO profits because they are new funds. The price per share is then calculated by dividing the total number of existing and newly issued shares by 100. This is what it means when people say an IPO is valued at. Third question, tell me about major items in shareholders' equity. The first is common stock. The most common type of stock in which most people invest is called common stock, which represents a portion of a company's ownership. Second is retained earnings, the amount of net income that the company has saved up over time. Third is treasury stock. The monetary value of the corporation's shares are purchased. Finally, additional paid-in capital. This accounts for the number of new shares issued as a result of employees exercising their stock options as well as the amount of stock based compensation granted. It also considers how much additional money a company receives from an IPO or other equity issuance. Next question, in a DCF, why would we use the mid-year convention? This is because a company's maximum cash flow does not always occur at the end of a fiscal year, but can occur evenly throughout the year. We would use the discount period numbers of 1 for the first year, 2 for the second year, 3 for the third, and so on if there was no mid-year norm. Instead, with the mid-year convention, we use 0.5 for the first year, 1.5 for the second, 2.5 for the third, and so on. Next question, what are your strengths? If you're asked this question, this is one of your best chances to demonstrate why you would make an excellent banker. Your analytical, quantitative skills, communication skills, the ability to learn quickly, detailed orientedness, and ability to work extremely hard are likely to be highlighted. You should be prepared to back up what you say about your strengths with 1 or 2 concrete examples from previous jobs or school. Next question. Explain the use of revolver in an LBO model. A revolving credit line is used when you need more money to make your mandatory debt repayments than you have available. The revolver, like credit cards, begins undrawn, which means you don't borrow money and don't accumulate debt unless you need it. Before calculating mandatory and optional debt repayments, add any required revolver borrowing to your running total of cash flow available for debt repayment. You assume that any revolver borrowing from previous years is paid off first with surplus cash flow before any term loans in the actual loan repayments. 7th question. Why are deferred tax liabilities and deferred tax assets created in the merger and acquisition transactions? These are generated as a result of the writing up and writing down of assets in a transaction, which include both tangible and intangible assets. An asset write down generates a deferred tax asset, while an asset write up generates a deferred tax liability. Because of the frequent differences between an asset's fair market value and its book value, which appears on the balance sheet, the asset must be written down and written up. A write up of an asset results in a deferred tax obligation because the new item will have a higher depreciation expense, which means you will pay less in taxes initially but will have to pay them back later, resulting in the liability. For an asset, write down and a deferred tax asset, the inverse is true. 8th question. How do you approach problem solving in a complex financial scenario? You could answer this question by saying, when faced with a complex financial scenario, I follow a structured approach to problem solving. First, I gather all the relevant information and data. Then I analyze the information to identify the root cause of the problem. Finally, I evaluate various options and make a recommendation based on my analysis. I always ensure that my solution is feasible, practical, and aligns with the client's objectives. Next question. Can you walk us through a recent transaction you worked on? So you can answer this question by saying something like, yes, I worked on a deal for a company and my responsibilities included conducting due diligence, developing financial models, and negotiating the terms of the transaction with the counterparties. The transaction was completed successfully and it was a valuable learning experience for me. And for the final question, what are some of the examples of non-recurring charges that are reflected in the company's EBIT or EBITDA when reviewing its final statements? First, goodwill detriment, then charges for restructuring and asset depreciation, legal expenses, expenses related to bad debt, accounting procedures are changed, expenses associated with a disaster.
If you want to make a career in data science, then Intellipaat has IIT Madras Advanced Data Science and AI Certification Program. This course is of very high quality and cost effective, as it is taught by IIT professors and industry experts.